discussing international investment planning. So the most important thing that you can do is get your attitude to risk correct along with your asset allocation. So you can see some of the points here where attitude to risk can change. Depends on the stage in life. So if you've got more than a 20-year time horizon, you should really be investing 100% into equities. And the reason for that is because over a 20-year period, equities have never gone down. So the longer time horizon you have, the more volatility you can take. And if you're benefiting from dollar cost averaging, so paying an amount every single month, 2 months, 3 months, year, then you actually want more volatility. Because if the market goes down, you're buying more units for the same monetary amount. The second point here is it alters depending on how on track you are to achieve your goals. So let's say you need £5 million to achieve all of your retirement goals by the age of 65. You've got to 60 and you're now at 7 million. You could potentially decrease your risk because you don't need to make any more money. Or you could view it differently and say, right, well, I actually am £2 million ahead, which means I want to take more risk because I can actually take more, I can lose more money without it impacting my lifestyle. Again, that just comes down to you as an individual. The last point here is more experience leads to more risk. So often I have clients that start off investing quite conservatively, and then as the years go on and they understand the volatility and they've experienced the ups and downs of the market, they're happy to take on more risk. The risk you take really will dictate the amount of assets you're going to end up with. And it's more important than reducing your taxes, because if you're reducing your taxes but you're only making 3% per year and it's hardly keeping up with inflation, and you compare that to 10% per year, I'd rather make 10% per year and pay taxes on my money. It's just an absolute no-brainer. Next point to consider is your asset allocation. So geographical region, we've already discussed this and the importance of making sure you have an international bias as opposed to your home bias. And countries like the UK, Europe have been stung by this because the markets haven't done well. Market capitalization. Nvidia, one company, is worth more than the UK stock market combined. It just goes to show that you don't need to just look at the geographical region, but the companies you're going to invest into as well. You have the option as well of investing into particular industries or themes. So if you want to, for example, take advantage of the AI revolution or crypto or whatever, there are certain ETFs that give you exposure just to these themes. The next point is bonds. So really for asset allocation, you've got stocks, bonds, and cash. With bonds, you've got either government bonds or corporate bonds. The credit rating is basically how secure the bond is. So you get investment grade bonds or junk bonds. Now, us as a company, just to let you know, we only invest into investment grade bonds. We don't go into junk bonds. And the reason for that is the default risk is higher. I feel you're much better off taking that extra risk in stocks than taking it in bonds. The last point is duration. So how long are you going to hold these bonds for? And this depends on whether you're buying active or passive bond portfolios. But for example, in the last few years, the bond market has had the worst 5-year performance in history. And that's because bond yields shot up so sharp. If bond yields go up, bond prices go down, which hurt people's portfolios. And you saw government bonds, long-term government bonds, for example, 20-year plus duration in the US and the UK, you saw drawdowns of 50% in 2022, which, considering it's supposed to be a more risk-averse investment compared to stocks, it was far worse. The last asset allocation here, which isn't really one that you should be paying much attention to, is cash. So there's always an element of cash in your portfolio, but you shouldn't have a big reserve of cash outside of what you're actually going to need. So a cash cushion is good, 3 to 6 months. Anything after that needs to be invested. And what you don't want to do is look at things on a very, very short time horizon. Well, I think markets are going to come down from here. That's great, but it's about timing the markets, not timing the markets. So keeping your money invested, you're always going to be better off than keeping it in cash. Okay? Sometimes it's a hard lesson to learn, and waiting too long is going to be detrimental, because since COVID, So only almost 5 years ago, the buying power of your money has reduced by 40%, which means every £100,000 you've got, £40,000 has been diminished by inflation. Portfolio considerations, so you can invest into either active or passive. We stick to a passive investment strategy. It's much cheaper, and if you compare active versus passive over the last 20 years, only 7% of active funds have outperformed their benchmark, and benchmarks are just passive investments. They're also a lot cheaper. The average active fund could be something like 0.8%, whereas passive is 0.15 to 0.3%. So you're saving money, and you're also on the 93% as opposed to the 7% side from active portfolios. The credibility of the asset manager is really important as well, because the big risk you have is the fund manager or the fund where your money is held going bankrupt. So we stick to the biggest fund managers in the world, companies like Vanguard, iShares, BlackRock, HSBC, because you get rid of the asset manager risk. They could default, but if they did, they're in the trillions, so there'd be something seriously wrong with the world if that did happen. I think there'd be bigger problems to worry about than the loss in your funds.